How often are margins set? Have you ever wondered how often margin requirements are adjusted in the world of options trading? Understanding this can help you manage your risk effectively. Let's break it down. Margin requirements are not static. They are established and adjusted regularly to ensure that traders maintain sufficient collateral in their accounts. The first time margins are set is at the moment a trade is executed. When you open a position, you must meet the initial margin requirement. For stocks, the Regulation T rule states that you need to provide this initial margin as soon as possible, but no later than 5 business days after the trade. This requirement ensures you have enough funds or securities to cover potential losses right from the start. Once the position is opened, margins are recalibrated daily. This is especially true for options trading, where exchanges like the Chicago Board Options Exchange requiring daily marking to market. This means that at the end of each trading day, the value of your options is recalculated. If there are any margin surpluses or deficiencies, they are determined based on this daily evaluation. If you find yourself in a margin deficiency, you typically need to meet the margin call by the next morning, usually by 9 o'clock in the morning, unless you receive a waiver. After the initial margin is set, maintenance margin requirements are monitored continuously. If the value of your account falls below the maintenance margin level due to market fluctuations, you will receive a margin call. At this point, you must deposit additional funds or securities to restore your margin to the required level. For stocks, this usually needs to happen within 15 days, while for options, it is often required by the next trading day. Additionally, exchanges and regulatory bodies periodically review margin requirements. They may adjust these requirements based on changing market conditions or volatility. While initial and maintenance margins tend to remain stable, they can change in response to extraordinary market events or for specific securities that carry higher risk. In practical terms, this means that margins are effectively set and recalibrated daily for options through the marking-to-market process. For stocks, you have a bit more time, but you still need to be prepared to meet margin calls promptly. This frequent adjustment of margins serves as a risk management tool, protecting both traders and brokers from excessive losses. Understanding how often margins are set can help you navigate the options trading landscape with more confidence.